Welcome back, everybody. This is Jacob Shoup. You're watching the Tom O'Brien Show right here on TFNN. Let's take a look over here at my computer screen. I'm on the newsletters tab of TFNN.com. Again, just type in TFNN.com. You're going to arrive on the home screen. You're going to go right over to the newsletters tab. And right here, the third column, first row, we have Mastering Probability newsletter by Steve Rhodes. Now, Steve releases Mastering Probability every day that the market is open. It is fantastic. It is in-depth. I strongly recommend checking this out, especially if you are just starting the new year, starting trading. This is fantastic. He goes over a lot of stuff, okay? And so what I want to say is that if this is the first time you've ever subscribed to a TFNN newsletter, really let's just say Mastering Probability, you can do so risk-free, 30-day money-back guarantee. I understand there is some apprehension sometimes putting money online. That is why we have built this in. If for whatever reason this newsletter doesn't work out for you, we are offering a 30-day money-back guarantee the first time that you subscribe. We are betting that it is going to work out for you, however. Steve Rhodes is also the host at 11 p.m. for the Trader's Edge. Steve, how are you doing?
Doing great. Now we got to work on your math statistics a little bit, or maybe there's something different in Tampa. It's more than 3% of the days that are good down here in Florida.
I know. Maybe
3%. That would be like 10 days.
I'm prone to hyperbole, Steve. I just remember, we had that nice gust at least in the Bay Area here, about a few weeks ago, and then it went right back up to 90s, and I just...
I know. Well, yeah. Look, I've been down here for over 40 years now, and you are right. There are time periods where it can get pretty sweltering, but I've been in Detroit and Washington, D.C., Atlanta, everywhere else where it's, maybe even worse or what have you. So more than 3%. I don't want the Chamber of Commerce coming after you.
Yeah, right. We don't need to get investigated or anything.
Yeah. So what I thought we would do today is... the spot VIX index. You and I, we've chatted about this before. Folks that listen to the Trader's Edge show at 11 o'clock, they hear me speak about it. Oftentimes people see this chart see this page right here. And the page has a ton of information on it, more than what just you and I have talked about. So, for example, you and I, we've talked about the one-day rate of change. And so the one-day rate of change, we look at both a one-day rate of change, the one-day rate of change between yesterday's close and today's close. When that is above plus 10% out there, what we'll typically see is the market move lower. But when it's above 10%, these blue arrows out here, they represent those days, by the way. We typically see a bounce or bottom, at least in the futures contract, the overnight session. In fact, just to switch gears here, one thing that you said that and then I'll come right back to this. Mm-hmm. What you mentioned, it was a great observation. I don't know if you and I chatted about this last week or not. And that is that we have seen a little bit of a cycle here where we see the futures markets rally overnight into the morning. Maybe when Europe starts closing around 11:30 or 12, we start to see a sell-off inside the U.S. So that's that phenomena we're seeing as global capital flows coming in overnight, okay, and then through the morning, and then we're seeing the U.S. say, well, thank you, we want to sell into this market, and that's one of the reasons why I actually wanted to bring up the spot VIX index, but just wanted to show folks, some of the amazing tools that are out there. There's also the one-day rate of change where price closes less than 10%. Below minus 10%, not 10% positive, but below minus 10%. And those are these green arrows on my charts out here, and they give us a signal of initiation to higher price out there. So it's a really great those two tools alone are just so helpful in understanding what the market is communicating to us. We've also got the 50-day exponential moving average, and where I use that, I take a look at the spot VIX index, which is in the bottom portion of our screen out there, the little blue squiggly line out there, and that red line is the 50-day exponential moving average. Above that is the S&P 500. And the green rectangles and yellow rectangles, the green rectangles represent when the spot VIX index is below the 50-day exponential moving average. And basically what we see here is the S&P 500 typically moves sideways to higher. Unlike when we take a look at those yellow lines, yellow rectangles or boxes out there, we have the spot VIX index above the 50-day exponential moving average. That's when we typically see markets start moving sideways to lower. At the moment, we are below the 50-day exponential moving average. We closed below it on Friday. The question is, where do we close today? So where's the 50-day exponential moving average right now for the spot VIX? It's only 322. So where's it going to close at 4 p.m.? I don't know where it's going to close, but if it closes below 1659, it still provides an edge to buyers out there of the S&P 500 or the ES Mini. If we close above that, what it's going to suggest to me is that the move on Friday was a false move to the downside of the spot VIX index, and that will then give sellers, the ones that have control. Now, folks can take a look at, since about 2 o'clock or whatever the time was this afternoon, we've seen sellers out there, so one can say sellers are in control. I'm looking at a bigger picture out here, looking at the daily chart, not really taking a look at the intraday signal. So those are things that you and I have discussed. If you look up in the top portion of my screen out here, what you'll see is that the spot VIX index right now, you can go out as far as September 2025 out there as far as the future contracts. And if we take a look at the spot VIX right now is really line number 2 on my screen. It's printed out at 1635. If you look at all the forward future contracts out here, what you'll notice is those are higher than that price. That's a normal condition. That is a normal spot VIX index condition. However, there are periods of time where, and if you look at here over on the left, you'll see I've got a 3-month VIX index. Everybody can get access to that. That's not a Stevie thing. There's a 6-month, and this was created a couple of years ago. Because what I'm going to show folks, I used to have to do manually by taking a look at all of the forward future contracts and compare it to the spot VIX index, and it was a lot of work. And we also have a 1-year spot index out here. So those are, and this is what I'm going to switch to right now. I'm going to switch over to a little bit of a presentation. It should be a little bit easier to kind of see out here. On December 18th, and I've got this notice on the very right. If you're watching us on Tiger TV, it's the very right-hand red, yellow arrow that you see on my screen. It's got the date right underneath it. But on that day, if you can picture, we had I think we had the Dow down over 1,000 points. I know it was over 1,000 points. We had the S&P, cruise lower by 100 points plus or what have you, and it looked like it was the beginning of the end. Right? I mean, that could have been the signal that was the beginning of the end. This is where understanding and utilizing the VIX. Now, this bottom panel of the chart takes the VIX index and divides it by that 3-month. When that ratio goes above 1, it's telling us, first of all, it's telling us that things have gotten out of line. It's telling us that the short term, which would be the VIX, versus, let's say, a 3-month VIX out there, that all the worry is right now. It's not something that is into the future, telling us about longer term that the markets want to absolutely move lower out there. Does that make any sense?
Yes.
Okay, so if we take a look at here, I'm not sure, I've got calendar year 2024 out here. So in calendar year 2024, we've had 3 instances where we've had the ratio again, the spot VIX index divided by its 3-month counterpart, go well above 1 as a ratio out there. And instead of that being the beginning of the end, that was the end of the, how would you say that? Instead of that being the beginning of the end, it really was the end of the end out there. You could, look at it's a really cool thing, because take a look at that it's actually formed bottoms out here. Now, look, that's just 3 examples. I know we're about to go to a breakout there, so I guess if okay with you, I'll stay with you through this second segment, and I'll share with people the other side of the story.
Absolutely. Steve Rhodes, please stay right there, folks. We will be right back with Steve Rhodes, author of Mastering Probability, right after this break. Welcome back, everybody. This is Jacob Shoup. You're watching the Tom O'Brien Show. I am joined right now by Steve Rhodes. Steve Rhodes is the author of Mastering Probability and the host of The Trader's Edge, live every day that the market is open, 11 a.m. Eastern Time, right here on TFNN. Steve, before we went to the break, we're taking a look at the VIX. It looks like we are still taking a look at the VIX. What else can we gain?
We are, because I want to. It's really this. Our segment here is really all going to be about the spot VIX. One thing I wanted to mention. So this is a really great tool, because as you can see, especially when you are in a bull market, and so this is all of 2024. We can see we're definitely in a bull market. When it gives us this type of signal, these have been major bottoms. Major bottoms. However, if we take a look at what I've got out here, we have a high in the in the Dow. I think that was right in the end of November, beginning of December. I don't recall the exact date. But I have just drawn in here a little bit of a descending trend line. Notice here that this one signal that we got back in August, that was a significant bottom. Price never came back, to even test that area. The same can be said about the one that formed here in the end of October. But we can't see the same. We cannot say the same thing that form. Oh, so the top was on December 18th. No, that was a big move lower.
The top, I believe, in the Dow was December 4th.
Perfect. Okay. Yeah. So it was December, but that December 18th low, we already have tested it, right? So something is a little bit different here. That's where I move over to this set of charts. This set of charts takes us back to 2022 when we actually had a top here. And you'll see same ratio of the spot VIX divided by the 3-month. Everybody can gain access to that. That's an easy thing to do out there. And I've noted those. And so the question really I'm coming back to here, when we take a look at, you get these big spikes on that ratio. They have led to rallies, but they haven't led to rallies where we don't see those lows again for quite some time. And here, if we take a look at back in the looks like the March timeframe of 2022, we had that one little nice signal there, and then all of a sudden, and it led to a rally 4, 5, 6 days, whatever that was, and the price came back in there and tested. We got another signal that led to a couple of weeks of rally out there, but we kept getting these signals, and what it wasn't really doing is identifying any kind of major bottom out here. In fact, it didn't do that until we got that very last signal in 2022, and that set up the next significant move inside of the stock market. So this can be an extraordinary tool, both in bull markets and in bear markets. In the bear markets, you're going to expect or anticipate bounces or bottom. And then it's up to us to be able to try to identify what's the pattern that identified the top in there to go back and to maybe reshort the market. Last thing that I want to do is take a look at the COVID crash out here. And here, if we take a look at that ratio, the 1 month, the 3 month out here, you can see it remained above it. So the important thing is, how do you know when this thing is actually making that bottom? You get above the +1 level, and when it gets back below that area, that's when it's telling you it should be a fairly solid bottom.
Sure.
If you take a look at the COVID crash out here, once we got above that 1-to-1 ratio, that lasted for quite some time out there. So there was never really, because it never got back below that 1 ratio where the spot VIX was less than the 3 month, the tool was never really able to be used. Does that make any sense? I'll make sure I'm not confusing. If I'm confusing you, then I'm confusing everybody else too, and I don't really want to do that. There's also a 6 month and a 1 year ratio, so you can do the same thing out there. I suggest that folks that are technical traders, if this is something that's new to them, they're just hearing this out there. It's such a great tool. You want to make sure that you've got it in your toolbox.
Definitely.
So now, where's that leave us? Now I'm going to go ahead and change screens here. Hopefully, I do this properly. And what we're going to do is, so how are we going to try to interpret the information that we're seeing here today? And first thing that we're going to take a look at is, so we know we could be in a market that's starting to move lower out there. We know that because of that last instance where we got that ratio reading that said it should be a major bottom. That was and that was on the 18th, and prices pulled back to test that area. When I take a look at the equity future contracts right now, we've got the daily for the ES, the NQ, the Dow, and the Russell 2000. Resistance here on a rally. If you take a look at the ES Mini, just as an example out here, I'll expand this out. Since the high that came in, and inside the ES Mini that was on December the 6th out here, we can also see that this green line, that's the oscillator and change line. We've discussed this before on the show. We can see how this is where rallies have stopped for the ES Mini. Earlier in the session, when we had the overnight buyers that were in there, looked like we were going to be able to blow through that. Then we have the U.S. sellers that come in here, and look where we're at right now. We are below that oscillator and change line. That reading as we speak right now is 6029, call it 6030 out there. That's what people would be looking at the end of the session today at 5 p.m. to see where the ES Mini has closed at. If it closes below that, even though it's above profile resistance, this could be a signal that we are really looking at a market that wants to move lower. We take a look at the NQ. The NQ today found resistance at the top of its daily profile, profile levels are where buyers and sellers are at. The top of the profile is where sellers are at exclusively. That number is 21,885 inside the NQ. Price got up there, rejected, and we're also trading below its oscillator and change line. If we take a look at the Dow, now the Dow generated the most bullish signal on Friday. It provided us with a bull sash candle that confirmed what I refer to as a Rhodes momentum indicator bottom. Those are bottoms when they typically form that we see price explode out. It doesn't have to be that very next day out here, but instead of we haven't exploded out, we got up to resistance. The oscillator and change line currently printing right now at 43,297, and we're trading below that. So of these four out here, it really would have been the Dow that I would have expected if we were going back to a bullish style market, that we would have blasted out through here, because it's the only one of these four that have a bottom. If we take a look at the Russell 2000, and I'm going to open this up, and the reason why I want to open this up is this morning during the show I got 3 or 4 different separate emails from listeners asking if they should go long the Russell 2000. Out there, and my advice was no. After looking at the chart even further, I didn't see this when in the initial observation this morning. The bottom panel of this chart shows us the tempo, the cadence, the little dance steps of the market.
Yes.
And typically markets, in bull markets, what you will typically see moves to the downside that are about 2 bars. 2 days, whether it's 2 days, 2 weeks, 2 months, whatever time frame you're looking at out there. And in bear markets, what we typically see, rallies last about 2 days. Many times they're just 1 day wonders out there, but many times it's just simply a 2-day rally. Since the high that we have inside the Russell 2000, that's November the 25th, we're looking at the black digits on the very bottom. What do we see here? We see a 2-day rally, or 2-day rally. That was into November 29th. We see one more 2-day rally, December 24th and December 26th. We might see one more 2-day rally. I don't know how we're going to close, but maybe we're going to get one more rally out here. Folks, use that VIX ratio between the 3-month and the 6-month and the 1 month out here. And what I'm suggesting right now in utilizing that tool and then taking a look at resistance levels out here, it's time for folks to be very cautious. We may be seeing a change in trend in this market.
Steve, thank you so much. We'll see you tomorrow morning, 11 a.m. Eastern Time for the Trader's Edge.
You bet. Take care.
Folks, stay right there. We'll be right back.